Welcome to the course Depreciation, Alternate Investment and Profitability Analysis. We are continuing with the module 3, that is profitability analysis. Today's lecture is devoted to return on investment. Return on investment. This is a profitability measure and is measured as the ratio of profit to investment. A high return on investment means the investment gains compare favorably to investment costs. Although several measures of profit and investment could be used, the most common are net profit and total capital investment. As a performance evaluator, ROI, that is return on investment, is used to evaluate the efficiency of an investment or to compare the relative efficiency of a number of different investments. ROI is equal to NP by F, where ROI is the annual rate of return on investment expressed as a fraction or percentage per year, NP annual net profit and F as total capital investment. ROI method does not use the concept of time value of money. Now, let us see the formula which is used for the ROI computation. If net profit is not constant year to year, and similarly if additional investment is carried out in the lifespan of the project, then ROI becomes one by n summation j equal to n npj divided by summation j equal to minus b to n fj, where n stands for the evaluation period of the project, npj is the net profit in the jth year, minus b is the year in which the first capital investment is made. In general, capital investment is made before the start of the production, and fj is the total capital investment done in jth year. Now, let us derive some terms. Net profit is equal to revenue minus all expenses minus income tax. All expenses is equal to cash expenses plus depreciation. Income tax is equal to revenue minus all expenses into tax rate. Now, net profit is equal to revenue minus all expenses minus revenue minus all expenses into tax rate. This is basically income tax is equal to revenue 1 minus tax rate minus all expenses 1 minus tax rate. This is equal to revenue 1 minus tax rate minus cash expenses plus depreciation into 1 minus tax rate. This is equal to revenue 1 minus tax rate minus cash expenses 1 minus tax rate minus depreciation 1 minus tax rate. Cash flow is equal to net profit plus depreciation or cash flow you can write down is equal to revenue minus tax rate minus cash expenses minus 1 minus tax rate minus depreciation into tax rate. For cash flow is equal to revenue 1 minus tax rate minus all expenses 1 minus tax rate plus depreciation. Now, these are some derivations. Now, net profit of a project are not generally constant throughout the lifespan n of the project. In such cases, an average ROI called average rate of return is used. So, average ROI rate of return is equal to average annual profit after tax into 100 divided by investment over the lifespan of the project. So, average ROI is equal to 1 by n summation j equal to 1 to n npj divided by j equal to 1 to n fj. There is another similar method, profitability method called average rate of return ARR. Though there are many alternative methods for calculation of ARR, the most commonly used definition of ARR is as follows. ARR average annual profit after tax into 100 divided by average investment over the life span of project. Now, the average profit is computed by adding expected yearly profits after tax for the life period of the project and then divided the result by the life of the project. Now, average investment in this case is computed as net working capital plus salvage value plus 0.5 into initial cost of the machine of project minus salvage value. So, based on ARR, obviously the project having higher ARR will be preferred to project with lower ARR. This method does not use the concept of time value of money. Now, let us take example 1. An investor buys stocks worth 10,000, cost of stock is equal to 10,000 and sells it after 1 year at a value of 15,000. If he pays income tax at the rate of 15%, then calculate return on investment. Now, initial solution, initial investment equal to rupees 10,000. Gross profit after a year is equal to 15,000 minus 10,000 equal to 5,000. Now, net profit is equal to 5,000 into 1 minus tax rate is equal to 5,000 into 1 minus 0.15. This comes out to be rupees 4250. So, ROI is equal to 4250 into 100 divided by 10,000 comes out to be 42.5%. Now, take another example. Now, the objective of the example is, given the initial investment and yearly non-uniform cash inflow after tax, compute the return on investment. Now, here example 2, two mutually exclusive projects C and D have similar initial costs rupees 50,000. Their cash inflows after tax are given in the side table. Determine the return on investment for both projects. So, we take example 2, initial cost of project C and D is equal to rupees 50,000. Now, cash inflow project C, project D, this is 1, 2, 3, 4, 5, 6, 7, 8. This is 12,500, 1,4,200, 15,000, 8,300, 4,800, 2,000, 1,100 and 0, and this is 9,980, 10,000, 9,720, 9,300, 11,000, 12,000, 14,000 and 14,800. Now, speciality of this is that after this 15,000, this is decreasing, almost very marginal cash inflows to the project C, whereas project D is consistently doing better. Now, if I use this method, you will remember that we have used this method in payback period and we have reached to a wrong conclusion. Now, let us see, this example is giving us the right selection or not. Now, average ROI average annual profit after tax into 100 divided by investment over the life period of project. So, average ROI of project C is equal to 12,500 plus 14,200, so on so forth, up to 1100 divided by 8 divided by 50,000. Now, this comes out to be 57900 divided by 8 divided by 50,000. This gives 14.8%. So, we got for project C average ROI is equal to 14.48%. Now, if I compute this for D, project D average ROI is equal to, for project D average ROI is equal to 9980 plus 10,000 plus dot dot dot, this is 14,800 divided by 8 divided by 50,000, obviously into 100 here, then only the percentage will come out, and this comes out to be 90800 divided by 8 into 100 divided by 50,000. This comes out to be 22.7%. So, this is 22.7%. So, obviously, my selection will be project D. As the average ROI of the project D is more than the project C, and hence the project D is better. Now, please note that the above decision is contrary to the decision taken in example 3 of payback period. Please also note that the method does not use concept of time value of money and thus does not adjust the profit with time. Now, we go to the example 3. The objective of the example 3 is, given the yearly non-uniform investment and yearly non-uniform cash inflow and the percentage of tax, compute the return on investment. The example 3 is, the investment and profit of two mutually exclusive projects C and D are shown in table, and if the tax is 30%, determine the return on investment. Now, the projects are cash inflow, this is minus 2, minus 1, 1, 2, 3, 4, 5, 6, 7, 8. This is project C, this is project D. Now, this is 0 0 because I will not get profit, profit starts at 1. So, this is 2200, sorry 22,000, this is 20,345, this is 18,760, this is 17,890, this is 15,660, 670, this is 11,000, this is 10,000, and this is 0. This is 0 here, this is 23,000, this is 19,900, this is 17,619, this is 16,543, this is 54060, this is 14340, this is 14,000, this is 14,800. Now, if you see the investment, cash flow. Now, at -2 you will remember that I was summing the investment with J is equal to minus B, and there I have explained that is when the profit starts, before that the investment takes place, and due to that this -1 and -2 are coming. So, it is -2 years my investment, project C, project D, this is 50,000, this is 5,000, -1 this is 5,000, this is 50,000, 50,000, this is 6,000. Now, at 4th year this there is an investment 4,500, and here there is an investment 3,200. Rest 3 digits are 0, 0, 0, 0, here 0, 0, 0, and then at the end here there is an investment of 2,100, here 0, there is investment of 2,300, here 2 zeros, here 3 zeros. Now, this is the scenario. So, there are different investments at different timelines, and there are different receipts in different timelines. If it is so, then how to compute the return on investment? Now, for this solution, n is equal to 8 years. So, ROI is equal to average annual profit after taxes into 100 divided by investment over the life period of the project. This I had already shown you. So, annual profit for project C the annual profit is equal to 20345 plus 18760. I am basically now the annual profit for project C is, I have to write down all these figures, that is 22,000 plus 20,345 plus 18,760 plus dot dot dot, it goes up to this 10,000. This comes out to be 11,565. This is annual profit. So, annual profit after tax will be 115665 into 1 minus tax rate, which is 0.3. because 30% tax is there. So, remaining is 1 minus 0.3 0.7 into this. So, this is remaining amount after tax comes out to be rupees 80965.5. Now, the investment, these are the investment figures. So, if I add them together 50,000 plus 5,000 plus 4,500 plus 2,100 comes out to be rupees 61,600. Now, average annual profit the profit has to be divided by the project lifespan, that is 8. So, this is 1 by n into 80965.5. Now, ROI is equal to now 1 by 8 into 80965.5 divided by, so into 100 divided by 61,600, this comes out to be 16.42%. Now, similarly for project D also I can compute. Project C ROI is equal to this. Now, project D ROI I have to calculate. This is annual profit is equal to say addition of all these numbers 23,000 plus dot 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 up to 14,800. This comes out to be rupees 135733. 135733. So, annual profit after tax is equal to rupees 135733 1 minus 0.3. It comes out to be rupees 95013.1. Now, investment, obviously these figures investment. So, that is 550,000 plus 6,000 plus 3,200 plus 2,300. This comes out to be 61,600 again. So, average ROI, sorry, average annual profit is equal to, my profit after tax is this. So, 1 by n into 95013.1. So, average ROI if I calculate, this becomes 1 by 8 into 95013.1 into 100 divided by 6,000, 61,500. This is investment is 61,000. Let me check the investment. 56,000 plus 3,200 plus 2300 0.5 61,500. So, this is 61,500 basically. So, this is 61,500 and comes out to be 19.31%. So, this is 19.31%. So, we have computed up to example number 3. Let us summarize. We are dealing with the profitability analysis in this lecture, and in the profitability analysis we have gone for the return on investment. Now, in the return on investment we have three examples, and in one examples which were solved for the payback period as well as return on investment, we saw that the return on investment gives better results in comparison to the payback period. Thank you.